So, happy Good Friday, everybody. The markets are closed. Netflix is obviously open for business. They reported very good numbers yesterday. I'm going to be joined, as always, on Fridays by my good friend and colleague, Professor Mark Guthner of Rutgers. And we are going to talk about the markets and tariffs and things like that today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe, and welcome to Office Hours with Professor Mark Guthner. Mark, how are you today?
Well, I'm terrific.
Good.
School is getting close to the end. Finals are coming up, so it'll be nice to have a little break, but there's always a sprint here at the end.
I kind of remember when we spoke about this last week that you actually thought you were going to be home on this Good Friday because a lot of schools are closed. Although, interestingly, here in California, I found out that the public schools are actually open today. That
Mm.
came as a bit of a surprise. But you said that you actually had a visiting professor from California coming to Rutgers to speak.
Yeah, as most universities do, they have a speaker come give a paper on Fridays. And since they were on the New Brunswick campus, I felt I had needed to be there. And we're supposed to be there, although I don't run up to Newark when they do them on Newark. Um,
I don't blame you.
that's too much work, too far away, too much driving. So um, yeah, and it was a nice conversation about the FDI, the balance between FDIC insurance and bailing out banks after the fertilizer hits the air conditioner.
Yeah. So, what's the quick takeaway on that? How well funded is the FDIC to handle uh, any potential risks where they might actually have to pay out depositors? Number one, and number two, aren't banks a little bit more secure now than they have been historically?
Yeah, I think the bigger banks are in better shape. Mid-sized banks still have some of that hangover of the rise in interest rate and unrecognized loss in their held to maturity portfolios. That's still there. That needs more time to work off. But it gets better every day. That's the good part. The FDIC never has enough money because they have like 8% of the deposits held in
Mm-hmm.
um, in a fund. So it's not very much. So if anything systemic happens, they're woefully short. But if it's a one-off here and there, they have the money to deal with that. But that wasn't the point of the paper. The point of this paper was what should be the balance of FDIC insurance up front versus well, let's not have an FDIC insurance. Let's just do the bailout at the back end. Because there's
Oh,
there's two ways to right. There's two ways to deal with the problem and keep people from undergoing a bank run. And the results of their paper was that the best thing to do is just bail them out after it happens and not bother with FDIC insurance. But like with all things, part of that comes with whatever assumptions were made in construction model, which was quite complicated. I don't know what because you got to do some pricing between um, what is it what do you pay a depositor if he's got insurance versus no insurance? What should be the level of insurance, in terms of account size? How much should they pay for it? It's a lot of moving variables. And depending upon what assumptions you make, you're going to get a different result. So,
FDIC premiums, those are typically deployed to short dated
yeah,
treasuries, longer term treasuries, or some
yeah,
balance. What's the duration
yeah.
of the FDIC book?
Oh, it's very short. It's treasury bills. They're not going out the curve at all that I am aware of. And these things are kind of funny, the way the government does something because they give the money to the government, and then the government creates an account and it buys treasury bills. So, and they do the same thing with Social Security and all the other trust funds that we have. And I always liken those trust funds as the briefcase in the movie Dumb and Dumber. I don't know if you ever saw that movie. but but Jeff and Jim Carrey, they're like the government, and they take money out of the briefcase, and then they just write an IOU and put in the briefcase saying that they'll pay it back, when they can, and so that's my sort of uh, yeah, view of these things, but. Um,
Yeah, I mean, I was curious to know what the total assets were. I guess it's
I don't know.
probably, I think they're cash and cash. I'm looking at it now. So their investments in U.S. Treasury securities is just shy of $115 billion, according to the FDIC's website. For those who are interested, you can go to fdic.gov/financial reports/diff balance sheet.
Yeah.
And then you can see some of the financials for the FDIC. It is a curious thing, of course, because all of these accounts or trust fund accounts where there's actually monies that are flowing into federal coffers and then deployed create a measure of support for U.S. debt.
Yeah.
And I'm not saying that it's a bad process. I'm not sure. I mean, what would they do with it otherwise, right? So, I mean, they're not going to take those things and invest in private assets, or they probably shouldn't. And
Well, they could
what
buy,
do they?
they could invest in commercial paper, A1 P1 kind of commercial paper. That is like almost that's very super low risk. Yeah, I think it's
But
bad practice to lend the money to yourself, but
well, the only thing I would say about that though is that the commercial paper market seized up in the GFC.
it did. Yeah, it did.
And that's exactly the kind of worst case scenario that one would imagine the FDIC is supposed to give a measure of comfort to
Hmm.
depositors about, right? So
Yep.
there was a mutual fund that actually broke the buck
Yep.
at that time.
Yeah, the prime
Excuse
fund.
me, a mutual fund, a money market account. So, and for people who don't know, money market accounts invest in very short-term debt, including commercial paper in some instances. And the idea is these are considered, obviously, as Mark just pointed out, exceptionally safe investments and highly liquid. That's so you can treat them like any other form of a demand deposit.
Hmm.
Demand deposit being something that you can demand your money at any time for any reason, and it should be fully liquid.
Yeah.
And obviously, if people got concerned that there was a liquidity crisis, they wanted to withdraw their money from the bank, and the entity that was intended to insure them against losses was invested in the same kind of commercial paper that they were already invested in. That seems like that has a recipe. So it's imperfect, right? It would be a little bit different if we still had a gold standard,
Yeah.
right? Because if you had a gold standard, there wouldn't really be much question what that would be.
Yeah.
If that was the reserve, then that's the reserve, and there it would sit. Okay. So, moving on, I thought we would just quickly touch on, because we talked about it a lot this week, Netflix earnings. They beat quite substantially yesterday. For those who were interested and followed along, and maybe I'll just quickly do a highlight tour of this, just in case anybody who's watching this didn't happen to follow along with that story. So what was very unusual about Netflix earnings is that it's not uncommon for them to report on a Thursday after the close. What is uncommon is for that Thursday to fall before a market holiday. And today being Good Friday, it is a market holiday. And what that meant was that the company was going to be reporting earnings on options expiration, because effectively yesterday was the last trading day. Now, you do have some time to file an exercise or a contrary exercise notice if you hold options. And so that created a very interesting dynamic. And, I had pointed out that you could trade cheap butterflies to the downside, get short the strike that had a lot of open interest on it. And maybe there was some chance that people who didn't know or understand that they could do this, or for whatever
Hmm.
reason were unable, not all of them were likely to be exercised, since they were not going to be automatically exercised as of the closing price, this in the event of a decline. In fact, of course, because the results were very good, the stock traded higher. And that will or would have happened to a couple upside strikes. I don't know where this... It was trading over 1,000 as of yesterday post-close. Let's just see where it got up to, and we'll see where it is now. So we'll just go to overnight here and see what's going on. So this was the closing prices as of yesterday. You can see here 973.03, and you can see that the stock was trading over $1,000. And I know somebody who traded against some of the open interest around the 980 level here.
Well, it raises an interesting issue because most option traders don't think about what's called the wild card option.
Mm-hmm.
And let's say just for round numbers, the stock is trading at $900, or you've got let's say you're short a call,
Mm-hmm.
and with a strike of $900, and end of trading, the stock trades at $890. So it's $10 out of the money. You expect it to be expire worthless. Day trading leaves. You go down to the bar for your to blow the froth off a couple, and then the stock takes off and it's trading up at 950, and then you wake up in the morning on Saturday and you realize that the option's been exercised against you, and you're going like, well, I wasn't expecting that, because of the price action afterwards, because people can call their broker after hours and say and take advantage of the fact that prices moved after the close and either exercise or not exercise.
Yeah, it's so the deadline, the OCC's deadline for exercise instructions or contrary exercise advice is 5:30. So your experience will vary a little bit depending on your broker.
Mm-hmm.
I use Interactive Brokers. Interactive Brokers deadline is 5:25. Didn't apply to me yesterday because the fly that I had on was the downside.
Yeah.
I suppose I can hope that would be awfully nice
Yeah.
if maybe somebody happened to assign me on the 950s, which means that I just bought a little bit of stock below the prevailing stock price, but I don't think that's going to happen. But yes, this is an important thing to think about. And there's one other thing I want people to think about too, because the person I was talking to, and I had said, hey, if you have he has a material position in Netflix. And I said, look, if you trade one of these flies, you can, exercise your long puts if the stock really plummets, and maybe you won't be assigned on the short side, and you get a little bit of cheap insurance possibly.
Mm-hmm.
Now, in his case, and I did mention that there are potential tax consequences to folks. He's been a long time Netflix bull. He has a very low cost basis in the stock. He has a similar situation in Costco, and he happens to live in California. And so in his tax bracket, subject to the highest tier of long-term capital gains rate, but plus his marginal income tax rate, meant that this would actually not be a good thing for him unless the stock basically got cut in half.
Yeah.
Because the tax implications were so enormous. Again, I'm not providing tax advice, but for those of you who are interested, these are things that you want to think about a little bit if you engage in a strategy like this. But it's interesting because money does get left around sometimes. Not often, but it does happen. I think there was a story about, a couple folks walking down the street, who work in financial services, and they're walking along, and there's a $20 bill on the sidewalk. And they walk right past it. The first one says to the other one, why didn't you pick up the $20 bill? The guy said, because if it was real, it wouldn't exist. The idea being that, there isn't any free money, but that's not entirely true. Sometimes you just get lucky. And that can be the case with situations like this, where stocks can move materially. And it is, the upside of it is you can potentially try to trade this as well, using expiring options. This does not work for cash settled options, folks. Just so you know, SPX options are cash settled, and they settle to the settlement price. So there's no, they're European. You don't get to elect to exercise. But in things that settle to an underlying instrument where you have a little bit of a window outside of trading hours on expiration, there may be rare circumstances where you can do that, and it's worth noting that for most market makers, somebody's assigned to sit around on every expiration and monitor exactly this issue. To see whether options that were out of the money suddenly go in, and if they do, typically they'll hedge with the underlying stock in the after hours, and they'll exercise and they'll trade around it until the last possible minute, and then if it's appropriate, they'll exercise the option. If it drips below a strike, for example, they'll buy the stock, it goes above, they'll sell, and they'll just flip it back and forth. And this is actually one of the reasons why stocks will tend to converge to a price oftentimes in the after hours as well, because liquidity has gone and people are playing for that exact issue. So you had a comment about the freight rates with China. Whoops! Unless we have a question. Yeah,
sure.
Let me just quickly see. Thank you for bringing this up. So Monday morning quarterback. I did a Netflix strangle swap. Long June 900, short 10. Okay, so you did the 900 1020, short the 417s, and okay, against the 922.5 and 1020s. Let me see if I can read this whole thing. Sorry. I did a Netflix strangle swap. So he was long June 900 puts and the 1020 calls. So far, so good. Short the April 17th 922.5 puts.
Later. I'm in the middle of a
and the 1020 calls.
I do every Friday, but will you be in your office?
Netflix traded around 1020 after hours, which may have put the 1020 long calls in a dilemma. Well, yes, that's right. So, this is the interesting thing. It did trade. Let's take a look. Let's take a quick look at this, because this actually is going to matter. So I'm going to look like this. We're going to go one day back, and what you're going to observe. So let's just take a. Actually, I'm not wondering why it's actually going back. Okay, no, that's all right. So here's what we want to look at. So it closes right here, 973. They put out the press release with the earnings right here. Then later on, they end up starting their conference call, but you can see that this was favorably received. I'm not going to say very favorably for Netflix, simply because Netflix is a stock that on average over the last 12 reported quarters or so has moved quite a lot. In fact, what we found is that out of the last, unusual whales data showed us that out of the last 11 reported quarters, 8 of them were beyond the move that had been implied by options before the fact. Mm-hmm. So here we have the stock going up, and as Monday Morning Quarterback points out, and I want to see if I can highlight this. If you can see where my cursor is, hopefully you can. It did get above 1020, and it got above it only very, very briefly. I do not expect that your 1020 calls are going to be assigned. And if they were, that's probably going to be a win based on how the stock traded thereafter. I mean, this is kind of a minor difference. I mean, $20 is 2% on a $1,000 stock, so it's not a huge deal one way or the other. But because it was above there so briefly, I think it's unlikely, because what would have happened is the holder of those 1020 calls, if it was a market maker, and chances are, I don't know what we can actually take a look and see what the open interest was, but a market maker would not exercise those calls until the very last minute. So when it got above 1020, they'd say, well, I'm long the 1020 strike, so I can now sell anything above here. And so, stock got up to 10, how high did it trade? 1024. So they could sell 1024 stock, and worst case, they get a free look, right? Because they could exercise their 1020 calls and lock in $4. But they're not going to exercise that call until they wait and see what happens. Because what could happen is that the stock will now drift below the strike, and maybe even by a decent amount, and they could just simply buy it back and play the same game again until the last possible minute. And in fact, that's exactly what happened. So somebody did sell stock at 1024, and the stock did in fact drop down below 1,000 thereafter. Mm-hmm. So if you had a one lot on even just a one lot. Think about that. You could sell 100 shares at 10.24, and then you could buy them back at 1,000. You just made $24 a share times 100. It's quick $2,400. So now it never recovered again. So that game only got played once. But my expectation is that those don't get assigned, and if they do, based on the price action thereafter, I think that's probably you were not assigned. Good, yeah. So that makes perfect sense. So Monday Morning Quarterback just updated, was not assigned on those. Yeah, that's not surprising because now on the other hand, had the stock at 5:25 Eastern Time been above 10:20, then I think that's the moment, right? So it all converges to a moment in time, the last possible moment when somebody can exercise or not. That's what's going to matter. And then they would just start shooting against the stock, and they might even lean a little bit short, who knows. But when we were market makers, this is what we would do. We would sit there, we would trade the stock until the last possible minute, and then we would put in our exercises thereafter. Okay, so let's move on. So Mark, you were kind of interested in what was going on in shipping rates with China on this sort of prolonged tariff uncertainty. So what I have up on the screen right now is the Baltic Dry Index. The Baltic Dry Index is actually kind of a composite of different shipping rates. So you have the Panamax, the Supramax, and I think it's one other shipping rate. So what is it? Panamax. So it's 40% Capesize, 30% Panamax, and 30% Supramax. And as we can see here, these rates have fallen quite sharply. They actually hit their lows earlier this month. But the thing that I thought was kind of interesting is that in some ways I'm surprised that they're not even lower. But I guess what's probably going on is that there was an acceleration we saw, I think, an all-time record in terms of our current account deficit with China in January. That, basically everybody was loading the boats. What do you think?
Well, what got me thinking about this is I saw a chart and I couldn't find it and I didn't save it, so I'm sorry for that. And it was saying that the shipping container rates going forward were plummeting in price because new orders are not going into China, so they don't need to load up the ships and send product to the U.S. So I wanted to share that with everybody to show that whatever is happening, that product being shipped is going to go down. Now, this has sort of an odd. It's like so many things in economics. What is the real effect of that? It's unclear if that lowers GDP or it increases GDP. So we know that GDP is investment, consumption, government spending, and net exports. So if your trade deficit goes down, that has the effect of making GDP bigger. So if the products that are not being shipped would be things that we would be buying, it's entirely possible that we won't notice this. In fact, you might even see a little blip, upward blip in GDP because the trade deficit gets smaller, which has a positive impact on GDP. Now, if on the other hand, there's a big component in there of, let's say, component parts that are needed to finish the manufacture of some product here in the U.S., that could slow down or stop the sale of product manufactured here. So that could lower GDP. And I don't know which is which. I'm going to guess it's more heavily to the former. But one of the things that globalization has done is oftentimes products move to 3 or 4 different countries before it's finished being manufactured and then finally delivered someplace. So I'm very interested in what's going to happen there, because the view in the financial media is that it's immediately horrible, that this is going to be very damaging to the economy. At least in the short term, to my way of thinking, that's a bit fuzzy. That's unclear. I don't think it's going to be anywhere near as bad as what they might be saying in financial media.
Well, it's interesting. I suspect that it's bad in the following sense, which is that anything that contributes to significant uncertainty is more inclined to get most or many economic actors to hit the pause button.
Yeah.
You know what? Whatever I was going to do, I'm gonna pause for a second and wait and see what happens. I don't want to make any really big long-term decisions until I know. And now those are real economy decisions, right? So that can, when we think about that kind of an impact, is that the same, for example, as if you had a decline in government spending, especially government spending to, say, pay a bureaucrat to do nothing, right? Mm-hmm. So that adds to GDP. It doesn't really add a whole lot of true economic value. There's some economic activity associated with that, because pay somebody $200,000 a year, they go out, they spend the money, so that flows into the economy. But is something really is something good being produced versus a comparable amount of either corporate investment, or private sector spending? Those, or as you point out, a net differential of $200,000 in net trade, right? So that would be, those are, in dollar terms, as far as the GDP thinks about it, they might be the same, but in true economic benefit terms, creating additional wealth, if we're thinking about the size of the pie, some of those are better than others.
Well, we also have the effect of the rush to deliver product here. So I don't know if you saw the articles, but I saw one that said that Apple shipped something like 6 tons of iPhones from India to the United States in the past, I don't know, week or two. A mad rush to do it. 6 or 7 747s full of.
And is that significantly more than they would normally ship?
The article didn't say, but I'm going to guess probably. They're probably quote unquote stuffing the channel to try to get product here so that there is something, and with the idea that I'm sure that if things blow over, then customers would never notice, a hiccup in the process. We also have this very short term versus intermediate term effect, whereas it might have a little boost short term, but then it has a drag longer term as the supply chain dries up. A lot of what we do on this just-in-time inventory is that the inventory is not held so much in a warehouse someplace, but somewheres along the supply chain. It's at a port in China, it's in a port in Thailand or something. It's sitting in a plane. It's sitting in a port here in the United States. If you drive over, I forget the name of the bridge, but going into Manhattan, you'll see a monster port with tens of thousands of automobiles just sitting there, waiting, to deliver them onto a dealership. But that's sort of like, that's the problem that we had with COVID, is that it didn't appear like there was a problem because all this product was still moving through the chain, and then it just went on for so long that there's nothing in the pipe anymore. So then we had this, we're out of product. We have this quote unquote supply chain problem.
Vapor lock.
And it takes some while to catch up. And then it's like, start shipping as fast as you can as soon as the governments let people start getting out and doing their work again. So I'm wondering if there's going to be a little bit of that. I'm not entirely convinced that it's going to cause a huge change in the price level in the U.S. like we're seeing again in the financial media. The way I think about it is if there's 2 things at play. Let's say that the volume of product we buy at these higher prices doesn't really change. Well, all of us would be spending more money on our imported items. That means we've got less money and we would be buying less of other things, things that were manufactured here, and their demand goes down, and therefore their demand goes down. So you've got one element over here driving up prices, and you got another force over here pushing down prices. So I think in the short term, again, we're not going to get this massive spike in prices, which you hear a lot of people on TV talk about.
So let's talk about what we can buy here, because some prices are down. Or is it a good time to buy? I wanted to talk about a couple things that have seen some interesting price action. United Health. So United Health, which was really one of the, I actually have it up on my screens right now. I'm going to actually throw up a long-term chart of this thing. I mean, this is just an absolutely remarkable long-term growth story. For those that don't know, Mark and I both worked at a financial services firm a number of years ago, where the head of research, Dr. Cheryl Skolnick, she was a PhD actually, was a huge, huge fan of this company. You probably remember that,
Yeah.
Mark. She would beat the drum on this thing for ages, and that would have been right around when was that? 2012, I think.
Yeah.
Yeah. So it would have been around 2012. And she would basically sing the praises of this business. Now ultimately, smart lady, she actually ended up going and working for United Health. She may still be an executive there. I haven't spoken to her in a couple of years, but she always had a lot of very favorable things to say about it. So I followed this, and I've observed that it was just one of the most consistent growers. Now of course, I'm talking about revenue and earnings growth over time. And it's a huge company on top of all of that. Yeah. Now, of course, we all know that we had that, horrible incident in New York where one of the company's senior executives was shot outside of the Hilton, a hotel I've stayed in many times myself, I have to say. And then they just reported some numbers this last week where their payouts were much higher. So when you think about the insurance business,
Yeah.
You collect these premiums and people try to model out the value of the business, and you assume that a certain amount of the premiums that you collect, obviously some of it has to go to your SG&A, so basically the operating expenses of your business. And then some of it, of course, has to get paid out in the form of benefits to the insured. And apparently that number came in much hotter than expected. So my question for you is this a blip, or is this something larger to be concerned about? Because if it's a blip, we are actually looking at a price now where the stock has essentially done nothing since 2021. And there's not a lot of places you can look for exceptional operators. I'm just going to go right back to here. So this is October of 2021. We can see the stock's in the exact same place. But there are some other things that are not in the same place. So, for example, trailing 12 months, $410 billion in revenues. It had $287.6 billion in 2021. Trailing 12-month net income was $24.5 billion. That's a substantial increase over the 17.3 in round numbers that they had back in 2021. And they've got about 20% more free cash flow.
Yeah.
So what are your thoughts here? Do you think this might be chronic? The whole space got hit. So Humana and everybody else in the segment. And this makes sense, right? Because if you have really big businesses that serve similar clients and services, there's
a lot of correlation.
Yeah, you're gonna have a lot of correlation because they are each are representative samples for the business of the other.
Well, I was going to say there could be a little Doge effect in here because I think a lot of people, investors, are concerned that reimbursements for plans through Medicare, Medicaid are going to get cut. And we saw articles where The government was paying many multiples of prices for drugs that the private sector was paying,
Mm-hmm.
and so there could be a little bit of that in there. So um, I think that the fear here might be a little founded in that the margins of the business are now somewhat in question. What I think is also interesting is we typically think of a stock like this as defensive. So if the
Mm-hmm.
economy is going to get a little wobbly, we want to go into healthcare because your health doesn't care about the economy. Uh,
And it's local; it's not subject to tariffs.
yeah, and here we are, a nice defensive name that didn't provide much defense. Somebody just did a 90-yard run on you, and so it's
Well,
there's lessons in all of this.
I mean, here's what I was thinking, and and if you disagree, by all means, please punch holes in it, because my attitude was this uncertainty caused options premiums to really jump.
Yeah,
The higher payouts and the concerns you cited, which is that that's what you cited as a revenue side.
yeah,
The payout ratio is an expense side issue, and if one comes down and the other goes up, bad for insurers.
yeah,
This is an unknown. The chances that the stock gets anywhere close to its prior all-time highs is quite low. And in the midst of all of this, options premiums, because of the uncertainty, are higher. So I think that you have the lower side potentially bounded by historically low trailing valuations for the business. And the upside is bounded by the fact that of these two issues that we just discussed.
yeah,
That revenue growth is probably not going to continue apace, or at the very least, there's good reason to suspect that it won't, and that the margins could narrow. But bearing in mind that, of course, it was factoring in larger growth rates, but the company is trading at a valuation, that saw 20-ish% lower earnings, and that would still be a reasonable number. If you think that 20 times earnings is a good number, and it's trading at 12, what does that tell us? That means that you could see a 40% decline in earnings, and it's still probably a reasonably valued business. So what I was thinking, and this is what I want you to shoot against, tell me if I'm totally out to lunch here, but my thinking was that folks could think possibly this is not a company that's going to get bought out right here now.
yeah.
Right? It's a behemoth, right? So that's kind of off the table. And I think the valuation equation might support it a little bit on the downside. So I was thinking, you could possibly look at selling a $100 wide strangle in this thing.
Yeah, and you could put an upside skew to that, your strikes.
Yeah, I mean this
There's
this
more
gives
upside.
you a buffer. Yeah, I mean this basically says you'll be put the stock at a 10% discount or so, that you'd sell it at a 10% premium to where it is, and you get a standstill. Let me just do this. Is probably make sure that this is there. We are. So you would get a standstill in this case. It looks like $13 and change over 42 days. So that's $13. $13 over 410, because that's where you'd be put the stock, which is 3.2% yield. Or over 500 if you want to think about it that way, right? So $13 and change over 500. I like to think about the yield that you're getting in terms of how much equity risk you are taking to do a trade like this. So you're going to get somewhere between 2.7 and 3.2% premium collection in the course of 6 weeks. That doesn't sound too bad.
No, not at all.
So okay,
And
so
I
you think that's
like
kind
you
of
said, there's
on side of
probably
that?
less downside than and more upside potential than downside risk.
Mm-hmm.
And that's what you always worry about. To my mind, if you're worried about a huge move, to me, you're normally worried about it on the downside versus the upside. It's much more often something craters than skyrockets.
Right.
And since this stock is trading at below historical margins, the world is coming to the conclusion or pricing the stock that says we're not going to grow, or perhaps we're going to shrink by 1% or 2% in terms of earnings per share for the next few years. And so it seems to me it's priced in a decent downside scenario.
Yeah, so that I thought that presented an opportunity. Just taking, sometimes you get, we have, obviously we're sort of getting into the thick of the earnings season now, and oftentimes we're going to be interested, about looking ahead to names that will be reporting. But sometimes I think we can take a look at names that have reported and see whether or not there's something for us to take advantage of there. Netflix numbers, as I pointed out, were quite good. For those who are subscribers to the Options Edge website, you'll know that we talked about a call spread risky there. So long, I think it was the 975 calls, and then short a broader strangle against that. I expect we'll know for sure on Monday, but I expect the vol crush will bring those wings in, and that call, at least as of the after hours price that we saw, is now in the money. So that should be a winner. If any of you did subscribe and did that trade, there's a decent chance you may want to think about adjusting your strikes.
Can you do a quick lookup on Netflix and see what their market cap is?
Sure. So market cap for
Netflix
is about $414 billion as of the close. It's a little higher than that because that is actually being fired off of.
I didn't see it directly from the company, but I saw articles or a news, video of somebody reporting that Netflix thought that they would be $1 trillion company by, what was it,
2030.
2030. That's a pretty wow number. And I just wondered, do you think that's
achievable?
Achievable, yeah.
So, yeah, in $20-30, I suppose. What's a $20-30 worth if we keep printing money?
There's that. That's true.
Could be $5 trillion. Let's. Yeah, I'm joking, of course. Let's be a little bit more serious about it. So here's the thing that I think is really interesting. So the company is, they really turned the corner and demonstrated in the same way that Amazon did.
Yeah.
That naysayers long felt that companies like Netflix, companies like Amazon were these paper-thin margin businesses that were never going to turn meaningful profits and meaningful free cash flow. And for a long time, these companies, as they grew and invested in their businesses, kind of proved those naysayers right. They just had, year after year of little or no earnings. In the case of Netflix, year after year of ever larger amounts of negative free cash flow. But the bulls always said, no. They're growing their business. They're building things out. They're building a moat. They're getting customer allegiance. And it will take only a minor tweak to the pricing model, and suddenly the profit spigot gets turned on.
Yeah.
And I think both companies demonstrated that that's true. Now, in Amazon's case, part of it stems from the fact that they are engaged in multiple businesses. Actually, I should have Amazon up first, so we can just talk about these things in turn. In Amazon's case, in fairness, so maybe I can bring up a multi-year income statement over here, and they always had good EBIT at Amazon, but they, in terms of their actual EPS, it was always trading at a high multiple. And basically what happened was they were able to tweak it. Amazon, of course, because, what were they at first? Everyone's like, an online bookseller. Well, now they're an online everything seller. And of course, it's their cloud business. AWS is a big part of their business. And that has nothing to do with, selling books. It's kind of a beautiful thing.
Mm-hmm.
And that is a business that once people get wrapped into the infrastructure of it. If your business is dependent on AWS, switching to Oracle or switching to Azure, so, Oracle's product is obviously Oracle, Azure is Microsoft, or to one of these others, is non-trivial. So you end up with some significant customer loyalty. You almost have to chase them away. Well, let's move on to Netflix. Well, Netflix, in some ways, is kind of similar. When people think about streaming, this is it, right? I think people would give up Paramount Plus much more quickly than they're going to give up Netflix.
Yeah.
And Netflix is generating its own content. Now they're bringing in sports. Kind of had some fits and starts there, but this is really critical. They are new media, right? So the legacy media companies are really trying to play catch up here. Mm-hmm. Their streaming services are demonstrations of this, but a lot of the content that the buzz generating content is being generated by the likes of Netflix. And sure enough, they've got this free cash flow growth. So
yeah,
full year 2025 free cash flow for Netflix is estimated. The consensus, the average is about 8.7 billion, and it's over 11 billion for next year. So that's 30% year-on-year free cash flow growth. Now, 11 billion. So I do this pretty often. Let's just go 11 billion over 400 billion. So that's a 2.75% free cash flow yield on 26 forward numbers with a 30% growth rate. So, if they do grow, so that would be, if they continue at that same rate, we're going to be looking at 31-ish billion in free cash flow by 2030.
Mm-hmm.
3%, assuming rates are basically where they are.
Yeah.
So $1 trillion valuation would be a 3.1% free cash flow yield on a 30% grower in 2030.
Yeah. So it's possible then.
So that is possible. Now, so that justifies it. So in other words, if you just simply take the free cash flow yield, the free cash flow growth that we've been seeing, and you just draw a straight line, then yes, $1 trillion probably is the number, actually. But can you draw that line?
Yeah.
Now, this gets trickier because I would argue that that growth is going to be difficult to achieve. Two reasons for this. One, they stopped publishing their subscriber forecast growth numbers because, of course, in many markets, there is some saturation, right? So you're not going to have the same kind of growth rates in the United States that you have had historically because people are subscribed. They had a step function change when they got rid of the sharing thing, right? So that was a really important and meaningful shift, and that actually contributed meaningfully to their profitability. What am I talking about? I had a Netflix account, I shared my user ID with somebody else, and now 5 people are using one account, and they're only billing on one. They got rid of that, and so that created that step function. So they got a subscriber growth out of that, and they priced it at a level where, it wasn't such a huge deterrent. People who became addicted to Netflix shows, and actually I think it was very wise, by the way, for them not to do something about it until they really were generating their own content and things like that. So, if you're just buying content from somebody else and then all of a sudden it just becomes a quick, oh, do I want to go to Amazon Prime Video? I can get somebody else's content there, or Disney, or maybe it was their content. Now that they have proprietary content, I think this was a good time for them to step in. Now they also have the ad-based business, which brings me into something else. So they have different subscription tiers. One does not have ads, one does. One does, one doesn't. The issue I have here is that subjects the company to ad pricing. Right? So if ad pricing comes under some pressure, that's a potential risk for them because they sell ads now for one tier of their subscription service. Now, I have said that I think in the streaming space, they're the one to have, right? There's not much doubt of that in my mind because even in my own household, I sort of follow that Peter Lynch philosophy.
Yeah.
I can't imagine people dropping Netflix. But I will say 30%, 30% growth gets you into the area of we worry about the laws of large numbers. You want to talk a little bit about the laws of large numbers when you're pricing stocks? I think some viewers might be interested in that.
Well, yeah, it's really simple. Small companies have a big growth ahead of them, and so they grow fast. And the bigger that you get, you've got fewer new or potential customers to go after. They get more expensive to go after too. So you
Hmm.
got your early adopters, they jump in, and the company is growing, and the company continues to offer a competitive price. And so lots of people kind of go in. Once they get big, how does the company make more money? Well, they're going to have to try to find a way to convince customers to pay a little bit more for their product to widen their margin because they're not going to get so many new customers once they've got most of the market. And then in some case, this is a typical S curve for a growing company. Once everybody's got a pair of Crocs, I mean, how many more pairs do you need? So they run into the same thing. I think the one thing that would suggest that they might make it though is, Paramount and Disney can't seem to put together decent content, and we saw that with Snow White here with Disney.
Ooh,
That
that was
was
kind of
what
a
did they say?
debacle,
They
huh?
spent 300 million on it, and they're probably going to get 30 million of revenue or some ridiculous spread. Was it 200? I don't remember numbers, but
I think it's going to be a little bit better than that, because I think opening weekend box office receipts were 65 million,
oh, that's much
and
higher than the number I
then
saw. So okay,
well, no, that's the gross,
okay.
right? And so what they get is going to be, we'll call it 40 cents on the box office dollar.
Hmm.
Um, and so that gets us to, well, let's call it 25 million opening week. Now, normally, it's not uncommon for people. So then you have to think about the decay rate, right? So everybody floods when a movie premiere comes out, and the theaters are full. And then based on the movie's popularity, if it's very popular, then it may stay right up there for several weeks. If
Yeah.
it's a middling movie, then you might get a decay of about 50%. So you did 60 million the first weekend, you do 30 million the next, you do 15 the next, you do, and so on. So it sort of slides
Then
down a
you got a
curve like
video.
that. And eventually, at some point, it's not worth keeping it in the theater because you have other things that'll probably do better, and you put that into those slots. And then, as you point out, you get the video receipts. But in this case, my understanding is that the week over week decline from the opening weekend was much steeper than it usually is, and that's because I didn't see the movie, and
Yeah.
my kids are too old to go see Snow White at this point. I have two boys in any case, so it's not really their thing. Um, Apparently, it was not very well received. People
No.
didn't care for it, and it sounded as if they made some very questionable creative choices with this. So I think one of the questionable choices was that they decided to substitute the dwarves, I think, with CGI or something like that, rather than real actors. And again, I didn't see it, so I can't speak to this.
Yeah.
But apparently, people who saw it just felt like it was
Well,
uh,
the point
was
that
kind
I
of
was
weird.
making, Mike, is that that's a franchise movie.
Mm-hmm.
It's huge. You go into the theme parks, there are rides that are connected to Snow White
Oh
and the
yeah.
theme parks.
Mm-hmm.
And here they are.
Big part of
That should
Disney's
have been,
business. Yeah.
they should have cracked that thing over the, center field fence.
Mm-hmm.
And that didn't happen. And they did spend blockbuster money to make it. So
It is
I
one of their
can't
most
remember
famous
when
stories.
Disney
It's
has
kind of
made
hard to.
something really great.
Yeah, it has been a while. I don't know what's going on there. They have, they have great properties. They have great stories, and they have a great way to merchandise
Yep.
their content. Um, I used to love that business. It was such a consistent, um, income growth generating business up until about 2015. The other portion, let's bring up Disney, because I think this is a good question too for people. What about Disney? This is obviously not one of the better performing stocks. Is this a good time to get into Disney after years of underperformance? And my answer to that, maybe I should. This is probably a little bit too long. Maybe
we need a catalyst. I'm going to
at
guess the stock trades where it did 20 years ago.
Well, let's take a look at, where was it 20 years ago? We'll do this. We'll just pull up a 20-year. So that would be a 20. Yeah, so 20 years ago actually brings the stock down to, and you're talking about just in terms of stock price. Let's take a look at what that is in terms of valuation.
Yeah, I can do it total.
Yeah, so that's a 40. What is that?
You want to share your screen, or can you?
Yeah, it's up, I think.
I don't see it.
I'm not sure if the producer. So, by the way, everybody, this being a holiday, our production staff is operating remotely, so they're traveling, brought equipment, and are testing whether or not they can do things remotely. So, unfortunately, I don't have a chart here.
All right.
Just so that we can think about this, a 20-year level in Disney is a discount of about 44% in the current stock price relative to where it's currently trading. So what would be the potential reasons why that would be justifiable? One of those reasons certainly is that the marquee property for Disney was not Snow White. It was not a cruise ship. It was ESPN.
Yeah, well, that's true.
Because for the longest time, the beauty that ESPN was the marquee affiliate fee property in cable. And what do I mean by that? So they would get basically a portion of every cable subscriber's bill would go to ESPN. High in demand, and sports are must see. It's not, nobody wants to go to watch the game days after it took place. People want this color, they want this commentary, they want the sporting events in real time. And ESPN was the marquee property in the space. And it accounted for a material portion of Disney's revenue. And it operated at a very nice margin. And of course, cord cutting has hurt that. And competition. Everybody from YouTube, Alphabet, and Netflix are now competing in this sports space. Mm-hmm. ESPN's still a great property, but it's not as great as it was. And even if they were doing as well as they historically had, these competitors are introducing uncertainty, which you have to discount into the valuation of that component of their business. But that would be remarkable because the revenues in 2005, 20 years ago, $32 billion. And the revenues now for Disney are around 92.5.
And yet the stock hasn't moved.
Well, the stock is higher.
A little bit? Okay.
Yeah, I'm saying to get back to 2005 levels,
Oh, okay.
stock would have to fall about, we'll call it 40%.
Okay.
But actually, let's take a look at this. The enterprise value, so the enterprise value then was 60. And the enterprise value now is 200. So we have a lot more net debt. So actually, this is interesting. So that's an important consideration, right? So to fall back to those types of prices actually is not a 40% decline in the enterprise value of the business. That's going to be a decline of 30% or so. So as we think about the whole value of the business, the combination of debt and equity, to get back to 2005 levels, that would suggest a 30% decline in the enterprise value of the entire business from where it currently sits. And that's not that hard, I suppose, to imagine. And also, so right now the company earned $4.87 a share trailing. And we were just talking about United Health trading only 12 times earnings or something. It's a really low number. So this thing is now trading at 17.5 times trailing. And actually, it was only doing $3 a share or $2 a share as recently as 2 years ago.
Hmm.
So one way to think about it is if you think that their business is going to get back into those kinds of levels, like it's going to earn $3 a share, that's 28 times that number. So actually, I don't know that I'm going to call for the stock to go back down to $50 a share, but there are ways it could happen.
Yeah.
To be sure, there are certainly ways it could happen. Okay, so let's just. How long have we been going here? About an hour. Let's just quickly
take questions.
Yeah. Well, let's see if there are any other questions. But also, for people who are going to be watching this recorded, because I think these typically get more recorded viewers, and I definitely expect that on a day like today, which is actually Good Friday. I'm assuming that some people are doing things with their family. Some people have the day off and so on, trying to take advantage of that, and good for you if you are. I thought we might just take a look at what is coming up. Oh, and I actually wanted to get your thoughts on this. What are your thoughts on precious metals here while I take a quick peek at what's coming up on the earnings calendar? Maybe we can pick a few things out there.
They seem like they're getting frothy to me. That I wouldn't get long here. If I didn't own them, I wouldn't buy them. If I own them, I would probably quote unquote let the profits run, but pretty quick to sell if, let's say, there was a 5 or 7% pullback, because I think we're looking for a tradable. I'm looking for a tradable top here at any time. I think
it's interesting.
I think gold has outperformed the S&P 500 now. If you go back, what was it, 10 years or 15 years? Which is rather surprising. So I think
this violates Warren Buffett's ideas about this. He's if you don't pick stocks, he always says just buy an index, and he says the only thing gold does is just sit there and look at you.
Yeah.
But apparently not. Does a little more than that.
Not. So gold goes through these swings where it really outperforms stocks, and then it really underperforms stocks, and then it outperforms. I think gold is doing quite well because people aren't sure what the impact of the tariffs are going to be, and it's creating uncertainty. If we have recession, then
it has massively
the government's going to print a lot of money.
This is astonishing, but I mean, it has massively outperformed the total return for the S&P 500 over the last 20 years.
Yeah.
So that's
crushed it.
Stock returns plus dividends.
Yeah.
So it has outperformed that by 50%. It's up 623% total return on gold, and gold, of course, does not pay a dividend.
Yeah.
Right? And that would be if you simply bought GLD, which means you're actually paying somebody else a fee to manage your gold for you. And still, net of all of that, it has beaten the S&P, inclusive of S&P dividends, by 50% over the last 20 years. And that's quite... I would actually say that that's alarming, because it tells us that something is very wrong. Actually, you know what else has really done well? I happened to spot recently? Verizon. So, I think, I was taking a look. What stocks are up this year? Obviously, Netflix. We talked about that. We talked about why, right? So, immune to tariffs, fee-based, no supply chain issues. You would assume that consumers who are maybe feeling the pinch, last thing they're going to give up, right? Because it's a whole lot easier not to go out to dinner, stay home, and watch a movie.
Yeah.
So discretionary, I've often sort of described it as an unregulated utility. But Verizon is up over 10% for the year. Total return is going to be even greater because it pays a 6% dividend.
Yeah, it's remarkable because they're so heavily in debt, and either they got to start paying that debt down, because at some point we're going to hit that cycle for G6, and then they're going to start to have to write some big checks to build out that next faster network. So I'm a little surprised, but it is a staple. Nobody's giving up their phone. Now, it used to be in the old days, you'd never give up your house.
This one here. Yeah.
Now you'll never give up your phone no matter what. You got to be connected to the outside world. If you don't have a job, it's what's going to help you get a job. And
I saw as somebody did a study, and they said that most households would give up their second car before they'd give up their phones.
yeah, that doesn't surprise me at all.
Yeah.
Doesn't surprise me at all. The world has changed.
Here's a really quirky and crazy idea. One thing I was thinking about when I saw these heavily indebted companies like Verizon, like AT&T, that if you believe that there's going to be some debt monetization, so you think there's $37 trillion worth of outstanding U.S. debt, and the only way is for them to print their way out of it to value the dollar. Is that a tailwind potentially for these heavily indebted companies, that a buyer of the equity is saying, I get to own the difference between the value of the asset and the value of the debt, and therefore they're playing for a widening spread? Is there anything to that idea?
There is if their debt is long term, so they've locked in a rate. So if you get higher inflation, you get the inflation up above your yield to maturities. When you originally sold your debt, then yeah, you're gonna make money. If it's all short term and it gets rolled over, I think on Bloomberg it'll tell you the maturity schedule of their debt.
Yeah, I'm gonna.
That's the issue right there. Is their interest expense greater than or less than the inflation rate?
Wow, do they have? There's 354 bonds in Verizon.
That's a lot.
That is a lot, and I'm getting a requesting data because I want to see what the weighted average.
Yeah. See, a lot of those are probably medium-term notes. Or fund managers need a particular maturity. And so they'll go buy 10, 20, 30, $50 million on a shelf offering to buy that. So that's probably why they have 350 different issues. And I would guess, 25 of those issues are actually really big and the rest are pretty small.
Yeah, I think that's probably true. So let's take a look at. Where's the. Oh, well, that was really helpful. I pulled all of this down without actually taking a look at the quantity of issues. So I was going to do a quick calculation to see what the weighted average time to maturity was and the weighted average coupon. But I'm not going to be able to do that because of the way I scrape the data. So maybe we'll touch on that when we get back to that whole thing next week.
Okay.
Which I hope we can do. And I'm going to let you get back to grading your exams
on
this holiday Friday. So everybody who tuned in, thank you very much. Like, subscribe, send us some comments, hit the notification bell, share and tell your friends all about this, and hopefully they can join us in future videos. And we will see you guys next week.
Okay. Cool. Good to see you, Mike. Have a nice weekend.
Happy Easter, everybody. Thanks for watching.
Happy Easter.
Call Jayco. Hey. What's that? Did the live stream end?
I don't think so. I think it's still going.
Oh, can I end it? Am I able to put the kibosh on it?